Why do you have to beg for permission to withdraw money that already belongs to you? Think about that for a moment. You walk into a bank, you ask for your own cash, and suddenly you're treated like a criminal planning a heist. The teller narrows her eyes. She asks why you need it. She suggests alternatives. She makes a phone call. If you want more than $10,000, they file a report with the government. Your own money, your own account. But the moment you try to take it out in meaningful amounts, the machinery of suspicion kicks into gear. Something is deeply wrong with this picture, and tonight we're going to trace that wrongness back to its source. We're going to talk about the grand illusion that keeps the entire banking system alive. We're going to discuss why banks are terrified of you, and why that terror reveals the most important financial secret of the 20th century. This is a story about bank runs. But more than that, it's a story about collective delusion, about a system built on a lie so elegant that most people never see it. It's about the psychology of crowds, the fragility of trust, and the moment when everyone realizes, all at once, that the emperor has no clothes. By the end of this, you'll understand why your relationship with your bank is not what you think it is. You'll see why the entire edifice of modern finance rests on a single assumption, and what happens when that assumption cracks. Let's start with the basic mechanics of the con. You deposit $100 into a bank. You think that money is sitting there, in a vault somewhere, with your name on it. You imagine it's waiting for you, patient and faithful, ready to come home whenever you call. But that's not what's happening. Not even close. The moment you hand over that cash, the bank takes 90 of those dollars and lends them out to someone else. Maybe it's a mortgage. Maybe it's a car loan. Maybe it's a business line of credit. Doesn't matter. The point is, your money is gone. It's out in the world, doing work for the bank, generating interest, building profit. The bank keeps $10 in reserve. 10%. That's the magic number, the fig leaf. The thin line between legitimacy and disaster. Now here's where it gets interesting. That person who borrowed your $90, they don't stuff it under their mattress. They deposit it in a bank. Maybe the same bank, maybe a different one. Either way, the process repeats. The bank takes $81 of that 90 and lends it out again, keeps 9 in reserve, and on it goes, like a financial matryoshka doll, each layer smaller but still real, still moving through the system. By the time the multiplication is done, your original $100 has become $900 of loans, all built on the same foundation of cash. 9 people think they have money in the bank. 9 people believe they can withdraw whenever they want, but there's only $100 of actual currency sitting in any vault. The rest is a ledger entry, a promise, a collective hallucination. This is called fractional reserve banking, and it's been the backbone of Western finance for centuries. It works beautifully, elegantly, efficiently, right up until the moment it doesn't. Right up until the moment people start asking questions. Because here's the thing. The system only functions if most people, most of the time, leave their money alone. The bank is counting on your inertia, your laziness, your trust. As long as you don't all show up at once, everything is fine. The gears turn, the interest flows, the profits accumulate. But if enough people get spooked, if enough depositors decide they want their cash right now, today, immediately, the whole structure collapses like a house of cards in a windstorm. There isn't enough money. There has never been enough money. The bank can't pay everyone because the money doesn't exist in the form you think it does. That moment of collective panic, that stampede to the teller window, that's a bank run. And it's the single most terrifying thing that can happen to a financial institution. Because once it starts, it feeds on itself. You hear your neighbor is pulling his money out. You think, why would he do that unless he knows something I don't? So you go pull your money out. And the person behind you in line sees you, and they think the same thing. Panic spreads like wildfire. Rationality goes out the window. It doesn't matter if the bank was solid 5 minutes ago. Once the run starts, once the crowd turns, the bank is finished. Let's go back to where this story really begins. Let's go back to 1933, to the absolute nadir of the American experiment, to the moment when the entire banking system nearly died. It's March. The country is drowning. The Great Depression has been grinding on for nearly 4 years, and it's only getting worse. 13 million people are unemployed. That's 1 out of every 4 workers. Families are living in shantytowns made of scrap metal and cardboard, places they're calling Hoovervilles, named after the president who promised prosperity and delivered ruin. Farmers are watching their land blow away in great black clouds of dust. Children are going to bed hungry. And every single day, more banks are failing. Not small banks. Not mom-and-pop operations in tiny farming towns. Those have already gone under. By 1933, we're talking about major institutions, banks that have stood for generations, banks that financed railroads and factories and the growth of cities, and they're collapsing. In the first months of 1933 alone, over 4,000 banks closed their doors. 4,000! Think about what that means. Millions of people walking up to buildings they trusted, buildings where their life savings lived, only to find the doors locked and a small typewritten notice explaining that their money is gone, not stolen, not embezzled, just gone, vanished into the ledger, consumed by the machinery of fractional reserve lending when too many people wanted out at the same time. The panic is spreading faster than the government can contain it. People are pulling money out of even the healthy banks, the stable ones, because they've learned the lesson. They've seen what happens when you wait. The survivors are the ones who panicked first, who got in line before their neighbors, who grabbed their cash and ran. The virtuous are ruined. The prudent are destroyed. And everyone who's left is learning that trust is a luxury you can't afford. Franklin Roosevelt hasn't even been president for a week when he makes the most radical decision of his political life. On March 6, 1933, he declares a bank holiday. Every bank in America, every single one, is ordered to close. Not for a day, not for a weekend, for a week, maybe longer. The entire banking system is shut down, frozen, locked. You can't deposit money. You can't withdraw money. You can't cash a check. The machinery of commerce simply stops. It's an unprecedented move, an admission that the system has failed so completely that the only option is to hit the pause button and hope that when you press play again, people have calmed down enough to make it work. Imagine that moment. Imagine being a regular person, a shopkeeper, or a factory worker, or a school teacher, and waking up to the news that you have no access to your money. Not because you did anything wrong, not because the bank you chose was reckless, but because the entire concept of banking is broken, and the president has decided the only way to fix it is to lock everyone out until further notice. The anger, the fear, the sense of betrayal. Your money is in there, behind those locked doors, and you're not allowed to have it. You can't pay your rent. You can't buy groceries. You can't make payroll for your employees. You're suddenly living in a cash economy, and you don't have any cash. Roosevelt goes on the radio. It's his first fireside chat, and the whole country is listening because what choice do they have? He's warm. He's reassuring. He explains fractional reserve banking in simple terms, walking people through the mechanics of how banks work, why they're vulnerable, what went wrong. He tells them that the government is going to inspect every bank, separate the healthy from the sick, and only reopen the ones that are sound. He asks for trust. He asks for patience. He asks people to believe that when the banks reopen, it will be safe to put their money back. And here's the miracle. It works. Not because the fundamentals have changed, not because fractional reserve banking suddenly became less fragile, but because Roosevelt managed to convince enough people, barely enough, that the worst was over. When the banks reopen a week later, people don't rush to withdraw. They deposit. They put money back in. The panic breaks. The run stops. And the system, battered and bruised and held together with government guarantees and collective wishful thinking, survives. But that moment revealed something important, something the government has spent the last 90 years trying to make everyone forget. It revealed that the entire banking system is built on confidence, not capital, not reserves. Confidence. The money in your account is real only as long as everyone believes it's real. The second that belief wavers, the second the crowd turns, the whole thing comes apart. So they built safeguards. They created the Federal Deposit Insurance Corporation, the FDIC, to insure deposits up to a certain amount. The idea was simple. If you know the government will cover your losses, even if the bank fails, you won't panic. You won't run. You'll leave your money where it is and trust the system. And for decades, it worked. The FDIC became the psychological backstop, the firewall between rational banking and mass hysteria. People could point to that insurance and say, "See, my money is safe. Even if the bank goes under, I'm protected." But here's what they don't tell you. The FDIC doesn't have enough money to cover all the deposits in America. Not even close. As of today, the FDIC has a fund of around $120 billion. Sounds like a lot until you realize that there are trillions of dollars in insured deposits across the country. Trillions. If a real crisis hit, if multiple major banks failed simultaneously, the FDIC fund would be wiped out in hours. They'd have to go to Congress, hat in hand, and beg for a bailout. Which means the insurance is itself a kind of fractional reserve system. It's a promise backed by the assumption that not everyone will need to collect at the same time. Confidence on top of confidence. Promises backed by promises. And underneath it all, the same fundamental fragility that brought the system to its knees in 1933. Let's fast forward. Let's talk about what happens when that confidence cracks in the modern era. It's March of 2023. Silicon Valley Bank, one of the largest banks in California, a darling of the tech industry, suddenly collapses. Not slowly, not with warning signs that give people time to prepare. One day it's fine, the next day it's gone. $16 billion withdrawn in a single day. $16 billion, the fastest bank run in American history, and it happened almost entirely online. No lines around the block. No people sleeping on sidewalks waiting for the doors to open. Just a cascade of electronic transfers. Money fleeing at the speed of light. Billions of dollars evaporating from the bank's balance sheet faster than regulators could even understand what was happening. Why did it happen? Same reason it always happens. Fear. Rumor. The sense that everyone else knows something you don't. Silicon Valley Bank had made some bad bets on long-term bonds, and when interest rates rose, the value of those bonds fell. Not a crazy situation, not a scandal, just a mismatch between assets and liabilities, the kind of thing banks deal with all the time. But someone noticed. Someone started asking questions. And in the world of modern finance, where information moves instantly and money moves even faster, questions turn into panic in minutes. The venture capitalists started pulling their money. The startups followed. And once the run started, once the first billion left, everyone else had to follow because the math is simple and brutal. If there are 10 billion in deposits and 9 billion has already been withdrawn, you need to be in that last billion out or you're screwed. Rationality doesn't matter. The fundamentals of the bank don't matter. All that matters is getting your money before the vault is empty. It's a prisoner's dilemma played at financial scale, and the only winning move is to defect first. The government stepped in. They seized the bank. They guaranteed all deposits, even the ones above the FDIC limit, because they were terrified of contagion. They were terrified that if they let Silicon Valley Bank fail, if they let depositors lose money. The panic would spread to other regional banks, and then to the big ones, and suddenly we'd be back in 1933 with the entire system on fire. And it almost happened anyway. Within days, other banks started seeing withdrawals. Signature Bank collapsed. First Republic teetered on the edge. The stock prices of regional banks cratered as investors decided that nowhere was safe. The run was going digital, going viral, spreading through the network faster than regulators could contain it. They threw money at the problem. They opened up emergency lending facilities. They made promises. They begged people to stay calm. And eventually, barely, the panic subsided. But here's what you need to understand. The response to Silicon Valley Bank revealed the truth. When push comes to shove, when a real crisis hits, the government doesn't follow its own rules. They said deposits were insured up to $250,000. But when a politically connected bank failed, suddenly all deposits were protected. The rules are flexible. The promises are negotiable. And what that means is that you can't actually trust the framework. You can't rely on the stated limits or the official guarantees because in a real emergency, everything is up for grabs. This is the secret they don't want you to realize. The banking system is not a machine. It's not a solid structure with clear rules and predictable outcomes. It's a psychological game, a mass delusion held together by collective belief. And the people running the game are making it up as they go along. Think about what it means to live in this system. You go to work. You get paid. The money goes into your account. You see a number on a screen. You believe that number represents something real, something you own, something you can access whenever you need it. But what you actually have is a promise from an institution that has lent out most of your money to other people, backed by an insurance fund that doesn't have enough capital to cover a real crisis, overseen by a government that will change the rules mid-game if the alternative is letting the system collapse. You don't own your money. You own a claim on your money. And that claim is only as good as everyone else's willingness to not exercise their claims at the same time. This is why they make it hard to withdraw large amounts of cash. This is why they ask questions and file reports and treat you with suspicion when you want to take out more than a few $1,000s. It's not about terrorism. It's not about money laundering. Those are convenient excuses. The real reason is that they're terrified of you. They're terrified that if enough people start thinking the way you're thinking, start asking for physical cash instead of digital promises, the whole game falls apart. Every dollar you take out is a dollar they can't lend. Every withdrawal is a tiny crack in the confidence that holds the system together. And if those cracks spread, if enough people decide they'd rather have cash in their hands than numbers on a screen, the banks are finished. Not because they're badly run, not because they're corrupt, but because the fundamental structure of fractional reserve banking cannot survive mass withdrawals. It's not designed to. It's designed to work only when most people, most of the time, leave their money alone. So they've built a culture around keeping your money in the system. They've made cash inconvenient. They've pushed digital payments and credit cards and mobile apps. They've created a world where carrying large amounts of cash makes you look suspicious, makes you look like a criminal or a weirdo. They've normalized the idea that your money should live in the bank, that accessing it physically is somehow primitive or backwards. And it's working. Most people never think about this. They see their balance, they swipe their card, they trust the numbers. They've internalized the idea that the bank is a safe place, a boring place, a place where nothing bad happens. The memory of bank runs has faded. The images of people lined up around the block, desperate and scared, feel like ancient history. Something that happened to our grandparents. Something that can't happen now because we're more sophisticated, more regulated, more advanced. But we're not. The system is the same. The vulnerability is the same. The only thing that's changed is the speed at which a run can happen. In 1933, It took days or weeks for panic to spread from one town to another. In 2023, it took hours. The fragility hasn't decreased, it's increased. Because now, everyone is connected. Everyone has instant access to information and instant ability to move money. The moment someone sounds the alarm, the stampede begins. So what do you do with this knowledge? How do you live in a system that you now understand is built on sand? You could pull all your money out, keep it in cash, hide it somewhere, but that has its own risks. Cash can be stolen, it can burn, it doesn't earn interest. And if the government decides to change the currency or invalidate old bills, you're stuck with worthless paper. You could spread it around, keep some in different banks, some in physical assets, some in things that hold value regardless of what the financial system does. Gold, silver, land, tools, skills, the things that mattered before banks existed and will matter after banks are gone. But more than any specific strategy, what you need is a shift in psychology. You need to stop thinking of your bank balance as wealth. It's not wealth. It's a claim on wealth, and that claim is contingent and fragile and subject to forces you don't control. Real wealth is what you can touch, what you can use, what you can trade directly without needing permission from an institution. Real wealth is your health, your skills, your relationships, the knowledge in your head, the tools in your hands, the food in your pantry, the roof over your head that you own outright. These things can't be frozen, can't be confiscated with a phone call, can't evaporate when confidence collapses. The bank wants you to think that wealth is a number on a screen, because as long as you believe that, they control you. They can lend out your money. They can profit from your deposits. They can keep you tethered to their system, dependent on their promises. But once you see through it, once you understand that the number is just a number and the real question is what you can do, what you can build, what you can survive on when the numbers stop meaning anything, you're free. Not free in some abstract philosophical sense. Free in the most practical, concrete way. Free from the need to beg for permission to access your own resources. The history of bank runs teaches us one lesson above all others. The crowd is always wrong until suddenly it's right. The people who pull their money first are dismissed as paranoid, as fearful, as irrational, right up until the bank fails. And then, retroactively, they were the smart ones. They were the ones who saw clearly. Everyone else was just trusting the wrong people. You don't have to wait for the crowd. You don't have to wait for permission. You can start now, today, building a life that doesn't depend on the promises of institutions that have proven, again and again, that they will break those promises the moment it's convenient. You can stop begging for your own money by recognizing that real security doesn't come from a bank account. It comes from independence, from resilience, from the ability to function when the systems fail, because they will fail. Maybe not tomorrow, maybe not this year, but the structure is still the same fragile thing it was in 1933. The psychology hasn't changed. The math hasn't changed. And when the next crisis comes, when the next wave of panic spreads through the network, you want to be the person who already moved, who already built something real, who doesn't need to stand in line hoping there's still money left when you reach the window. The bank run is coming. It's always coming. The only question is whether you'll be ready.